Hi everyone, Joe Gentili from Sarraf Gentile LLP. In this video, I'm going to be talking about a problem that I've seen a lot of, unfortunately, in recent years, and that is people in older age mostly dealing with universal life insurance policies that have lapsed or universal life insurance policies that are in danger of lapsing because the cash value has been depleted and they're becoming increasingly expensive to keep in force. And most of the policies that I'm seeing on this front are older policies. They've been in force since the 1990s. And the story generally goes like this. A person bought the policy in the 1990s. They were given an illustration. The illustration shows that the policy has a very robust returns on it. Let's say it was illustrating an 8% return. And using that 8% return, there was a target premium that was created, and the person or the policy owner paid that target premium religiously, in this case for decades. And the life insurance agent that sold them the policy at some point disappeared from their lives. The really nobody was doing any policy reviews. So they just assumed that as long as they paid the premium or the target premium that was given, the policy would stay in force. And that's not what happened. What happened is that the policies generally returned the minimums guaranteed in the policies in terms of crediting. So they got 5% returns, or in some cases 4% returns instead of the 8. So what happened over time is, as the cost of insurance increased on the policy, that cash value buildup that was supposed to be there, and due to really good 8% returns, just wasn't there. So over time, the cost of insurance started eating into the cash value to the point where the cash value got depleted, and people were stuck with these very large cost of insurance charges or premiums to keep the policies in force. That, unfortunately, was a very, very common story that played out. I've been involved in several class actions, successful class actions, where there were legal actions that we could take to try to offset this problem to some degree. Because while what I just laid out is not really a legal problem, although let's say there was a legal problem with how the policy was sold, but the statute of limitations is long over on that. But what has happened is that when a carrier issues a universal life insurance policy, they almost always have language in the policy that gives them the ability to adjust the cost of insurance if their expectations on the underlying portions of the policy don't perform to expectations. So for instance, they'll almost always say that if mortality experience is not what we expect, we have the right to adjust the cost of insurance. And what we saw is that those trends I laid out before, they were happening with a lot of people that bought universal life insurance, but it was made even worse by the fact that carriers raised the cost of insurance on it. And like I said, they had the ability to raise costs of insurance if people were dying younger than they forecasted or some other issues, but that wasn't happening. People were living longer. But what had happened is that those 5% and in some case 4% guarantees that they were giving people on their returns, while that was less than what people were expecting to make on those policies, it was more than the insurance companies could earn on them. So they tried to make that up by raising the cost of insurance, which is not allowed under the contract. So we saw cases and successfully filed cases where the cost of insurance was raised, and we were able to help ameliorate those raises. Another genre of this that we've seen is that the language in the policy says that they're going to adjust the cost of insurance, or visit adjusting the cost of insurance depending on mortality, right? Whether people live longer or shorter. So as I said, by and large, if you bought a policy in the 90s, if you fast forward to today, people are living longer than was forecasted back then. So because the mortality experience is better, some universal life insurance contracts created an obligation on the part of the carrier to lower the cost of insurance to reflect that. And carriers haven't always lived up to those contractual obligations. And we've had cases related to that too, which have also been successful. So the point of this video is to say that if you have a universal life insurance policy that you bought a while ago and it's lapsing, or you suddenly get this demand for a lot more premium than you thought you'd owe, these are the likely explanations for it. It's worth it to have an attorney look over the policy if this is happening to you, because there's been a number of instances where lawsuits were possible, where there was some legal liability on the part of the insurance carriers for either raising the cost of insurance or not lowering it when they had an obligation to. So I think it's worth it to have an attorney review that, particularly an attorney that's experienced with class actions and experienced with life insurance issues. So if you have any questions about this video or about the intersection of law and life insurance and annuities in general, as always, please feel free to reach out. And if this is a topic that interests you, I encourage you to subscribe. Thanks for watching. Bye.